Today, I'm thrilled to welcome a new guest speaker to the program, Daniel Culbertson. He's an outreach economist at the Indeed Hiring Lab with a focus on the U.S. labor market. Indeed has been a sponsor of the RPOA annual conference since we started the event in 2022, and we greatly appreciate their support of the association. For the past 2 years, Daniel has shared his market insights at the conference. This year, I invited him to the webinar program to share his insights with all of you. I have many burning questions. I hope Daniel will help answer for us. So without any further ado, welcome, Daniel. I'm going to pass it over to you.
Thank you. It's great to be here again, and glad I could join this year. So yeah, my name is Daniel Culbertson. I'm a senior. Some of you may be familiar if you saw me at the conference over the past 2 years, but for those who aren't, my name is Daniel Culbertson. I'm a senior economist here at Indeed, and I work on our Indeed Hiring Lab team, which is our global research outfit that we have on staff at Indeed to see what insights we can tease out of Indeed data and use a lot of public data as well. And that's the purpose of the presentation today is a U.S. labor market outlook. This will cover some broad trends that are impacting all different areas of the labor market. But also I'll talk a little bit about the human resources space. But in general, this is just a high level view of what is going on in the hiring landscape, if you will. So I'm happy to walk through these slides.
Daniel,
Oh, yeah.
go ahead and share your slides.
Oh, yeah. Oh, sorry. There we go. Yeah, here's the slides that we're talking about. So I'll be happy to share these with you all afterwards. So you should have a copy of these, but I'm going to walk through these. And then if there's any questions at any point, I believe there'll be some time afterward for some Q&A. So I'm happy to answer any questions that you all may have about the content you see, but also if there's any other questions about the labor market or the economy, I can do my best to answer those as well. So without any further ado, let's dive into some of these slides. And there are a couple topics at hand to cover to get a good overview of what's going on across the labor market. This first section is all about the labor market slowing down, but that focuses on the supply side and the demand side of the labor market and some of the differing trends that we've seen there this year. I'll talk a bit about wage growth and what we've seen most recently there with Indeed Zone data. Given our job postings information, we have quite a bit of information on wage growth. Similar with remote work, we have some information there, and we can see how those trends have held pretty steady over the past year or so. And then I'll wrap things up talking about the economic outlook and that possibility of recession and where that all stands. We don't do any of our own forecasting, so I don't have my own forecast to share, but I certainly have some thoughts to share about where we are in all this and what next year could look like, or what we're hoping for next year. So getting started with that first section, and this largely focuses on supply and demand. But here I say that the labor market has slowed to an inflection point. And what I mean by that is the labor market has been slowing down for the better part of the last 3 years. Typically, when you say the labor market's slowing down, that's bad. But given how hot the labor market was running coming out of the pandemic recovery, we wanted to see the labor market slow down. I say we're at an inflection point because we've now reached the point where we don't want to see the labor market slow down anymore. As human resources professionals, you all have certainly been experiencing this the past couple of years. And, things have slowed down quite a bit, and you've probably already been feeling like you're at the point where you don't want to see the labor market slow down anymore. From an economic standpoint, and thinking about what the Federal Reserve has done lately, we're certainly now at the point where we don't want to see the labor market slow down anymore. And I'm going to walk through some of the data to show what we mean. So every month at the beginning of the month, we get our jobs report from the Bureau of Labor Statistics. We'll get the next one tomorrow morning, bright and early, on the East Coast at 7:30 a.m. 8:30 a.m. on the East Coast, but that's details we don't need to hear. This report gives us a lot of information about the overall labor market. It's where we get our unemployment rate, it's where we get the jobs number, and a whole host of other information. This jobs report that comes out has been getting a lot of attention the past couple months. Sorry. It's been getting a lot of attention the past couple months, and that's because what it has showed is that the labor market has slowed down even more than it was already slowed down before. So this first chart that we see is what we call the jobs number. That's the month over month change in payroll employment, which tells us very simply, did the economy add or lose jobs over the past month? In 2023, we were averaging about 250,000 jobs added every month. That's a very strong clip of job growth. But what we can see here over the past couple of months is that the month over month change in payroll employment, how many jobs the economy has added, has slowed down quite a bit. We're well below that average of 250 from 2023. The last couple of months have come in and around 100,000 jobs added every month. So the economy is still growing. It's just not growing nearly as strong as it was before. And 100,000 jobs a month, that's actually very slow job growth. We'd probably want to see it a little north of that. The other part of that jobs report that's raised a lot of eyebrows recently is an uptick in the unemployment rate. This chart shows both the main unemployment rate, which is this red line here, and then the blue line here is a different measure of unemployment that I'll go into in a moment. But the main unemployment rate has ticked up over the past couple months. A couple things worth pointing out. So you'll notice that if you look back at the past couple of years, we are at the highest unemployment rate we've had over the past couple of years. But you can also see that 4.2% unemployment is still an incredibly low unemployment rate. So there's not really much concern about how high the unemployment is right now. What the concern is how it's been trending up the past couple months. And we certainly never want to see that happen. And so that's something we'll be keeping an eye on. This other measure of unemployment is essentially a view of the unemployment rate that shows more of the slack in the labor market. This includes people who have recently stopped looking for work completely, which the regular unemployment rate doesn't count. It also includes people working part-time that would like to be working full-time. So it's a broader measure of unemployment, but I put this here to show that this is only ticked up a little bit as well. And it's something to keep an eye on. We don't want to see that get worse, but it's still in relatively good shape. And we'll get some updates on these numbers tomorrow, and that'll give us a whole new picture of how the labor market looked in the month of September. From the Indeed data standpoint, we can also see the labor market slowing down. So the Indeed hiring lab team, our bread and butter is Indeed job postings data. This is the job postings index that we put together. This shows the overall trend for all job postings on the Indeed site, any type of job anywhere inside the United States. We show this as an index. So February 1st, 2020 is equal to 100 here on the left side of the chart. And you can see how job postings have trended since then. After the labor market slowed down pretty consistently for the past almost 3 years now, we are still above our pre-pandemic level. As of September 27th, the Indeed job postings index is still about 12% above its pre-pandemic baseline. The Bureau of Labor Statistics job openings series, which is a very similar data trend, that looks quite similar to this. That's still above its pre-pandemic level as well. And so that tells us that demand for workers is still relatively healthy. It's just come down quite a bit from its post-pandemic high. Another thing worth pointing out is you'll notice that this job posting trend has been pretty flat over the past couple months. I think it's still very early, or maybe too early to say that this is maybe where the labor market is settling down. Maybe this is the new normal. I would want to see this extend out a couple more months before making a call like that. To give you a sense of how this looks in some of the different job categories across the labor market, actually, before I dive into this, let me say something that I forgot to say at the top. So the Hiring Lab team, which I'm a part of, we have a blog site, hiringlab.org, which is free to everyone. Everyone has access to that site. And that is where all of our research and all of our labor market commentary lives. And also on that site, you can click data at the top right of the page. That'll take you to our data portal, where you can see the latest in our job posting trends, our wage data, which we're going to see in a moment, We have a remote work tracker, which we're also going to see, and then we have an AI tracker as well. It's a great source for data and labor market insights. And inside of that job postings category, you can see our job postings data broken out by country, state, city, metro area. You can see it by any which way you want to see it. And job category as well, like we're doing here. And that data is all there at your fingertips. You can download the data, screenshot the charts. It's all right there for you. And so this is one of the charts that you could pull from that data portal, but this shows the job posting trends for nursing, software development, and human resources. Nursing I included on here because it's a pretty good proxy for all of healthcare. As is typical, no matter what's going on in the economy, healthcare tends to hold up a bit better. And you can see the nursing trend line went higher during the pandemic. It's declined at a much slower pace. It's still above the labor market average. So nursing's still holding up pretty well. Therapy, physicians and surgeons, and personal care and home health aid roles, those are still pretty much flat over the past year, which means they're holding up better than anything else in the labor market. Software development, you can see there's a huge decline in tech roles and software development roles a few years ago. And this is really yet to recover, and this is well below its pre-pandemic baseline. Also, there was a lot of change in, software development was a category that was very predisposed to, what happened in the labor market during the pandemic. There was a lot of hiring inside of tech during the pandemic recovery. There's a lot of companies that were in a pretty good position to hire inside of tech, but there was also a big correction. Something similar happened in human resources, as I'm sure you all have seen and experienced. There was an incredible demand coming out of the pandemic for human resource professionals as everyone was trying to hire at the same time coming out of the pandemic. But we've also seen quite a slowdown. And human resources job postings are now just below their pre-pandemic levels. So we have just less HR postings on our site now than we did pre-pandemic. So sort of a full run up and correction there. And we really haven't seen human resources bounce back yet, which makes sense because we really haven't seen hiring recover from the slowdown over the past couple of years. And speaking of hiring, not really coming back, that's something we can see right in Bureau of Labor Statistics data. So those trend lines that we just saw, that was indeed data from job postings, and that was a good picture of demand for workers. Where the rubber actually meets the road for human resources is with actual hires. And this is Bureau of Labor Statistics data on the hiring rate, which is just the number of hires every month as a share of total employment. And so we're looking at level changes here. And what we see is that hiring has been, as we've all experienced, hiring has been slowing down quite steady over the past 2 years. The hiring rate that we have most recently is right back to where it was in about early 2010s, which was a labor market that was still recovering from the global financial crisis. And that was a very slow recovery in hiring, as you can see here. And so this just goes to show how much hiring has slowed down. And this is a very good example of a data series that we probably don't want to see slow down any further. If this hiring rate continues to slide, then we're probably getting closer and closer to a possible recession. So that hiring rate is pretty much bottomed out right where the Federal Reserve wants to see it. That's why they cut interest rates a few weeks ago, because they want to start spurring the economy again. But we'll get into that when we get into the section on the economic outlook. One of the areas that we've continued to see the labor market improve over the past year is with labor supply. So this chart shows labor force participation rates measured by the Bureau of Labor Statistics. And we break this down by age because that's still where some of the important differences are when it comes to labor force participation. The pink line here is the bulk of the labor force, those aged 25 to 54. Their labor force participation rate, which is just the share of that population that's either working or looking for work, that's above its pre-pandemic level. It's been above its pre-pandemic level over the past couple of years, and it's picked up over the past year. This is the improvement in labor supply that we've seen. It's great news to still see workers in such a broad category still coming back into the labor market. It means higher application volume. It means much less labor markets that are much less tight. Where we still have some of the gaps when it comes to labor force participation is with older and younger workers. You can see here from that yellow line, that older labor force participation rate for that older cohort really hasn't recovered from where it was pre-pandemic at all. So there's likely a lot of early retirements there, and those workers probably aren't coming back. The blue line is younger workers. There's been a lot of volatility there, but there's been a bit of a setback in the past year or so. That still hasn't recovered to its pre-pandemic level. So it's likely a lot of host of different factors that are keeping younger workers out of the labor market. It could be staying in school longer, could be childcare issues, it could be younger workers just cycling in and out of jobs more as they tend to do. But either, at any rate, if there are segments of business that you're helping recruit for that tend to rely a bit more on younger entry-level workers or those older, more experienced workers, those are still two areas where labor supply is a bit more fraught. Another way that labor supply is improved is just with retention. So from a business standpoint, this is great news. Retention has come down quite a bit. This shows the quits rate, which is the share of workers voluntarily leaving their job every month. And this tends to move in tandem with what's going on in the overall labor market. When the labor market is doing very well and there's a lot of opportunity out there, this quits rate will rise like we saw it do during the recovery from the pandemic. But with the labor market slowing down as much as it has, the quits rate has come down quite a bit, and it's back below pre-pandemic levels. So that great resignation that we saw for a couple of years coming out of the pandemic has turned into the great stay. Workers are very cautious about the labor market. They're very apprehensive about leaving, and they're holding on to the job that they have. To switch gears a bit, I wanted to talk about wage growth. That is an area of the labor market that we have seen normalize. And by normalize, I mean it's gotten back to where it was pre-pandemic. And so this is something that we measure using the information from job postings on our site. Employers post from information that employers put inside of the job posting, whether it's on a salary or a wage. And we track that over time to get our own measure of wage growth. Now, wage growth peaked at about 9% year over year during the heat of the recovery from the pandemic. That's incredibly high wage growth. With demand cooling off, with supply getting better, with inflation becoming less of an issue, wage growth has cooled down quite a bit, and it's at 3.2% through the end of July, which is right back to where it was pre-pandemic. And this is about what you would expect to see in a labor market that's functioning. I know the labor market slowed down quite a bit, and I've spent a couple slides pointing that all out to you, but it's still a rather pretty healthy functioning labor market, and that's what we have right now. And you would expect to see wage growth at about 2.5%, 3%. There's still a little bit of variation when you dive into different categories. So there are some categories where we've seen year over year wage growth slow down quite a bit, and that includes retail, therapy, nursing. And there are still some categories that are getting wage growth either well above the overall labor market average, which is marketing is a good example of that. But human resources, some of those personal care and home health roles, wage growth is right about in line with that labor market average. And so the amount of pay, there's pay rates, right? The level that folks are paying for roles, but the amount of those increases that we have to see every year has normalized, and it's right back to where you would expect to see it. Remote work is still an area that, for all the news that we've seen about return to office, and we've seen some major names announce return to office in the past couple months, remote work is still pretty persistent. We haven't seen these trends have slowed down, but we haven't really seen them slow down all that much. And this is something that we watch both through the job postings and job search angles. So this is job postings data on remote work. This is the share of the job postings on the Indeed site that either mention remote, hybrid, anything related 1 to 2 days a week, telecommute, whatever it is, anything related to remote work. Now, this is down a little bit over the past year. You can see there's a little bit of volatility there. It has come down a bit from its post-pandemic high, but at 7.5% of overall job postings, it's still much closer to its post-pandemic high than it is its pre-pandemic level. And a lot of this decline that we saw in 2022, 2023, a lot of that was due to tech jobs slowing down so much, which have a high share of remote work. Tech job postings, as we saw previously on those slides, they slowed down quite drastically. And that's what brought down this overall trend in remote postings. So we really haven't seen opportunities for remote work slow down all that much. And job seeker interest is still there as well. When we look at the share of job searches on our site that mention remote work, it's still just above 7.7%, down a little bit over the past year, but again, still closer to its post-pandemic high than it is its pre-pandemic level. So we certainly know job seekers are still interested in these roles. And to switch gear back to job postings, just to give you a sense of what some of this looks like, we've seen not a lot of change when we look at this by job category. This is just a random sample of some job categories that tend to be office jobs or white collar roles, if you will. The bulk of these have been pretty constant. If you look at the middle of this chart, there's not a lot of change there. We are seeing some slowdown in remote job postings inside of, for example, software development, IT, accounting is another one. And we've seen a little bit of a pickup in legal or insurance, but most of these categories are still pretty constant. And so we haven't seen any major changes inside of remote work, except for maybe accounting, which was a pretty drastic change there. That could be due to some major accounting firms if they've changed some of their policies or taken that out of a lot of job postings. That could have been the driver there. I wanted to wrap things up talking a little bit about the economic outlook and where we all are. And I've already mentioned once before that, and I'm sure you all saw in the news, that the Federal Reserve did cut interest rates earlier this month, which was a signal that, that is a change of outlook for the Federal Reserve. Over the past couple of years, their focus has been reining in inflation, which is why they raised interest rates to begin with. They wanted to slow down the economy. But with the first interest rate cut, that means we are now past the point we are likely past the point where they're going to raise interest rates anymore. And the Fed is now focused on spurring economic growth through these interest rate decreases. They want to loosen up the reins a bit on the economy, and that includes the labor market. As I mentioned before, they don't want to see the labor market slow down more than it already has. And that the labor market, as I mentioned, is still in relatively good shape. We're still adding job openings, so demand for workers is still elevated. Layoffs are still low. The labor market's in fine shape. It's just slowed down so much over the past couple of years. Where this leaves us is with an economic outlook that has improved over the past year. In lieu of our own forecast, you may be seeing me point to this before, but I always like to reference this Wall Street Journal survey of economic forecasters. They survey about 60 economists every month. One of the questions they ask is, what are your odds of recession in the next year? This time last year, or last summer, I should say, in 2023, the odds of a recession, according to this group of economists, were about a coin flip, about 54%. But over the past year, with inflation getting better, it's not completely solved, but the inflation problem has gotten a lot better. Inflation came down. The labor market held up. That increased the odds that we might get through all this without a recession. And that's why you saw the odds of recession come down here. But I want to point out, we're going to get the October numbers soon. So we'll have an updated look at this soon, later this month. But at 28%, the odds of recession haven't completely gone away. We're still in a period of uncertainty. The Fed is cutting interest rates to spur economic growth again and loosen up the reins in the economy. But it's still possible that we could backslide into a recession. We're not completely out of the woods yet, so there's still a high degree of uncertainty. But the takeaway here is that things are still uncertain, but the economic outlook has improved. And with that, some of the things that economists are watching, a lot of things still depend on inflation, right? If the Fed starts cutting interest rates, as they've done, and if they keep doing that, but they start to see inflation pick back up a bit, then that's going to give them a lot to think about. And so they're going to keep a close eye on inflation, because that could complicate the picture if that becomes a problem again. Hiring, I mentioned that we've seen that slow down quite a bit, and we don't want to see that slow down anymore. But that's from a labor market economist standpoint. That's something we're watching very closely. And also layoffs. That's been remarkably flat through everything that we've seen the past couple of years. If that changes, that's a very clear indicator that the labor market's taking a turn for the worse. And so it's obviously something that we don't want to see. And so across the labor market, supply and demand have gotten a lot closer when it comes to supply and demand for workers. There are still some labor markets out there, especially some of those higher skilled roles, technical roles, that are still dealing with very tight labor markets. And so everything that you've done the past few years to recruit in a tight labor market, I think is still valid today. And this is general advice for recruiting in a labor market, in a tight labor market, that you may have seen from me before, but pay is always going to be important, even in a labor market where wage growth is slowing down. Pay is always important to job seekers. Transparency as well. We have an update on our salary transparency data coming out later this month. It's now about 57% of job postings on the Indeed site that feature an employer provided wage or salary. And so it's more common than not to have that information listed. So it's a great way to get everybody on the same page when it comes to the job seeking the hiring process. And also it's a great way to draw eyes to your job postings. You want to deepen your talent pool any which way you can, which could include job training, bringing people in from other industries. It could include loosening up rules on backgrounds or criminal records, practicing fair chance hiring. Also, anything that's restrictive in your hiring process that's maybe not absolutely necessary, like perhaps drug testing. If you can get rid of that, that's a great way to open up that funnel. Speaking of opening up that funnel, recent hiring lab research shows that the share of job postings that mention some type of degree requirement or years of experience requirement has fallen over the past couple of years. So employers are much more focused on, or becoming more focused on, certain experience or levels of skill instead of just educational requirements and years of experience requirements. That's a great way to open up that funnel too. And lastly, that flexibility piece. Remote works for a small share of our overall labor market. And if it works for the businesses that you're working for, you'll make sure they're very clear about what remote work means for them. That way everyone's on the same page. And then for those on-site roles, any flexibility that can be put in there is a great way to draw job seekers as well, because we know they still desire a lot of that flexibility. And then lastly, hiringlab.org. As I mentioned, everyone has access to this site. It's a great way to follow along with what's going on in the labor market. All that information is available for you for any which way you want to use it. But I encourage you all to check that out. And thank you for your time and your attention today. Hopefully, I know this was a lot of info, but hopefully this was helpful in getting a sense of what's going on across the labor market. If anyone has any questions or any perspective they want to share, I would certainly be happy to hear it. But thank you for your time, and thank you for your attention.
And thank you, Danielle. Excellent presentation. I'll keep an eye on the chat if there are any questions, but I have to say you answered my questions quite well, because we've been hearing and out there that the economy is doing well, which relatively speaking, the US is a strong economy. I think the story that we heard today was more tailored to the TA audience and our RPO audience, which is, it was interesting to see that drop in jobs in human resources. So that is a validation, I would say, over this year and through last year as well. I haven't seen as many members reach out to the association looking for jobs and just sharing. It hasn't been an easy market for people in human resources. And we could see from the data that is the case. I was speaking to someone yesterday who started his career 5 years ago during COVID, and he's waiting for things to be normal. So we'll see what that looks like. I was also curious when you were sharing your data, if we scheduled this webinar a week from now and get the results from the job report tomorrow, if the story would be any different. I'm guessing probably not much.
I mean, that really depends on what kind of numbers we
Yeah.
get tomorrow. I don't think it would be drastically different. The story wouldn't be drastically different. The main story and the main theme of this is that, we have a labor market that's slowed down, and it's at the point that we don't want it to slow down anymore. And I'm glad you made that first point about human resources, because I wanted to drive that home, is that, you probably hear myself or a lot of other folks say that, the economy is in really good shape. And it is, but all economies are local in a sense, right? And so broadly, the national economy looks great, but in certain pockets of the country, it might look very different, and then in certain business lines, it looks very different. And human resources is one of those. I know the slowdown in hiring, the overall slowdown in the labor market that we've seen really hits the human resources space pretty hard, and so that's they've been taking the brunt of that slowdown in a way. And so I know things haven't seemed great in that space, but with the Fed, as I mentioned, with the Fed cutting interest rates, part of that is to loosen up the reins on the economy and hopefully facilitate some more growth. That's not going to happen overnight. Just because the Fed cut interest rates earlier this month doesn't mean October or November are going to be banner months for the labor market. It's going to take time for those changes to flow through the labor market and the economy, but hopefully we can anticipate hopefully a little bit of a stronger 2025 when it comes to hiring. But that's all
Wait
still
and
up
see.
in the air. Yeah, we'll
Mhm.
see. But yeah, to answer your question about tomorrow's numbers, if you want, I can wait and send out this deck tomorrow. That way I can have the new numbers in there for you. That's certainly possible. But I don't think those numbers will drastically change anything unless we get some, even if we got some incredible jobs numbers tomorrow, that's just 1 month of data. Or even if we got some really bad looking numbers tomorrow, that is still just 1 month of data. And, one thing we say is you always want to look at a couple months worth of data before you call something a trend. So we'll see what we get tomorrow, though.
All right, so we get a few questions for you. Take the first one. The question is, if you were to say you need to recruit or look for business, what area would you recommend?
Um,
So I guess what industries are recruiting, have high recruiting needs?
oh, okay. That's a very good question. I mean, healthcare is a pretty, we learned during the pandemic that not every, or not it, there, we learned during the pandemic that no category is really recession proof, right? Healthcare certainly went through it during the pandemic in a much more brief way than some of the other aspects of the economy. But every place can be impacted. But that's the point I'm making there. But I would say healthcare is as good a space as any. We've seen our own job posting data. We see in the public data as well that healthcare is holding up pretty well, which it tends to do. So anything related to healthcare recruiting is probably your safest bet. Yeah, and I would say that's probably the safest and probably the one big safe bet right now. We've seen so many other areas of the labor market pretty consistently slow down, and so I would say if you're looking for a role or if you're looking for an area where you're going to be busy working, healthcare is probably your best bet right now.
All right, so I don't know if this is a fair question, Danielle. Feel free to pass on this because it's a prediction question. The question is around the upcoming elections in North America. What do you think the impact on that of these elections on manufacturing in particular?
That's a good question, and that's one I get very often. And obviously we have two very different candidates this election cycle that have very different proposals, and in some ways they could mean very different things for the overall economy. And to be honest, as a labor market economist, I'm not really an expert and some of the differences between their policies. And so I'm not in a good position to speak about the potential impacts of one side winning versus the other. I will say though that, you know, in the lead up to the election, a pretty common refrain or a common question is what impact does that have on the economy, it being an election year. An election year doesn't really change all that much for the data. I think anecdotally or on the margins, there might be a little bit of hesitation from companies that have exposure to some of those areas of the economy that might be impacted by an election. You might see some of those companies pull back a bit, but broadly, when you look at labor market data or economic data, the election years really aren't different from any other. And so I don't think the election itself has all that much of an impact. And then, you know, the outcome of the election, I mean, it not only depends on which side wins, but it also depends on which side wins the presidency, but it also depends very greatly on which sides in the House and the Senate. And it's a lot of variables there. And I quickly get out of my depth if I try to answer that question.
All right, so probably a fair question here, and the shift is let's not talk about the election, but let's think of what the Federal Reserve changes they might be making and cutting interest rate going forward. Thinking of the audience, I think what everyone wants to know, where should they be looking, investing their resources as RPOs, as recruiting professionals, on what industries that might benefit and see uptick in hiring, and so position for that for scaling up when that happens.
That's a good question. I don't know if I have a great answer there, at least in regard to what happens on the other side of interest rate decreases, right? When the economy starts to pick up, and part of the, well, yeah, part of the reason I think I don't have a great answer here is that on the other side, on the previous side of that, or so a couple of years ago, when the Fed started raising interest rates, a common question was, what are the industries that are most likely to be impacted? And traditionally, for a long time running, the common thought was that, well, any business that tends to rely on a lot of financing is going to be most directly impacted by interest rate increases. Money becomes more expensive. So construction in particular, real estate, manufacturing, you know, those are the areas that would be impacted by the interest rate increases that we saw over the past couple of years. But we really didn't see that. The economy sort of like everything sort of slowed down at the same pace, and there wasn't a lot of evidence that those interest rate increases impacted specific industries. And so on the other side of that coin, I don't know if there's really going to be any benefits to, actually, I mean, I don't know for sure if there's going to be any particular industries that benefit from those interest rate decreases, but I think that standard logic does still apply, that, okay, if the Fed is cutting interest rates, if money's becoming less expensive, then those industries that require a lot of leverage and a lot of financing, like construction, real estate, manufacturing, those would be the categories to still bet on, and to maybe concentrate resources, particularly real estate. You know, real estate's in particular has had a tough couple years, especially during the initial stages of the pandemic when things started to freeze up. And so with interest rates coming down, if mortgage interest rates continue to fall, real estate would be a good category to specialize in, especially in addition to construction, manufacturing, those that are, you know, best suited to see that growth from interest rate decreases.
Well, terrific. And I have to say the Hiring Lab does publish great articles and content and reports, and it's one of the resources that we monthly reference in our newsletter. So I do want to wrap our webinar. We are out of time, but thank you for the audience for great questions. And I do want to share upcoming webinar from the RPOA that you would be interested to know about. November, today we heard from Indeed on the state of the labor market. In November, we're gonna host our partners at Everest Group to look specifically about the state of RPO based on their insights and data. I'm looking forward to hearing their insights on how RPO did this year and maybe what their outlook for the upcoming year. And the registration is open on our website. If you are registered for the conference, I look forward to seeing you on Monday. That is happening this coming Monday, October 7th and 8th. Otherwise, I look forward to seeing you at an upcoming RPOA webinar. Thank you all for being on the call. Daniel, thank you so much. Great webinar today.
Thank you for having me. Good to see you all, and enjoy the conference.
Thank you. We'll miss you.
Take care.
Take care. Bye-bye.